It is Friday. It is time for Risk and Rewards. I'm Lisa Abramowicz with John Authers on an incredibly eventful and in some ways confusing day. The news of the day was this labor market report, November jobs report, that came in way below expectations. The expectation was for north of 500,000 new jobs created. Instead, we got 210,000, but it wasn't all bad. What do you think, John? I'm going to put you on the spot with the most underrated aspect of this labor market report?
There are a number of them. I think the straightforward unemployment rate is compiled in a different way and suggested a strong improvement compared to last month. It has to be the single most important one. I'd also point out, I don't think that enough attention has been given to the fact that government jobs appear to have declined last month. So, if you're bothered about fiscal spending, and there are reasons for that, but one of the problems with not spending so much for the government is that the government gives jobs to fewer people. The other point that does baffle me at this point, I don't understand it, is we had a straight down the line, rip-snortingly good ISM services number.
Yes.
As a sequel, the best ever, as in ever. Okay, they've only done the services since '97 or something, but just unambiguously very, very good, far better than expected. And the market has been behaving as though bad news is bad, and bond yields are going down and stocks are going down since this, home run of a services number came out. So I don't get that at all, but I think it's underrated.
Let's take it a step back, because there's the labor market report, which came out at 8:30 a.m. Eastern. And then there's the 10 a.m. services number that came out. What did you call it? Rip-snortingly good, which I love, and we'll try to weave into my common speech on a regular basis. Just sticking with the labor market report, and then we will go to the services report, which is fascinating. You're right. I want to really talk about not only the participation rate, which rose to its highest level going back to March of 2020, right? A good sign, still below where it was, but also the unemployment rate, which also went down to the lowest since the pandemic started in February 2020. It went down to 4.2%. Now, we can talk about all of these sort of myriad inputs and why they don't seem to agree with each other. But if this is really the case, if these numbers are concrete and can be believed, how can the Fed justify that we are very far away from full employment when we are so close to where we were really ahead of the pandemic?
I would say they can't. I mean, the only justification would be to do with avoiding a serious market accident, given how much liquidity is floating around, and that is actually a fairly good justification. They've got to be careful about how they take their foot off the gas, how they release the water, or whatever analogy you want to use. But I just don't see any reason at all from the economy for emergency level easy monetary policy, like just none. There is no need for it.
Which is the reason why the consensus right now.
I mean, we've had Bullard since Jimmy Bullard, the St. Louis Fed, coming on since the numbers came out, talking fairly hawkishly. Again, I'm flummoxed by what's happened to the bond markets in the last hour or so, because it's more or less the opposite of what I would have thought needed to happen in terms of the actual level of yields.
I'm going to stop you there. There are a couple of issues here. The idea of the bond market response. Initially, the knee-jerk response was actually yields lower on the front end, possibly delaying a rate hike. Then people looked at some of these numbers and said, forget about this. The Fed is absolutely going to hike rates. This absolutely does not deter them. It just shows them there is this sort of momentum in the labor market. You saw 2-year yields rise to their highest levels going back to at one point matching March 2020. I'm looking at all of this, and you're talking, I think, about the absolute level of yields, but also the yield curve, right? The idea that you saw the biggest flattening, and you saw the flattest curve going back to the beginning of this year for the 210 spread, the benchmark spread, and then even more so on the longer ends. Is this indicating a policy error before the Fed even makes the policy move?
I'm inclined to say that that it is. I mean, the way I put it in a column is if you combine that with what's happening with break-evens, which are dramatically lower, like 0.5% for 5-year break-even has come down by more than 0.5% in 2 weeks. So from when we still thought Lyle Brainard might be the new chair of the Fed to now, inflation expectations for 5 years have gone from 3.25 to 2.5 in round number, 2.6, 2.7, which is very, very, very dramatic. I think there is great confidence still that the Fed can deal with inflation. All they needed was to hear that Powell wanted to be hawkish, and they had that confidence. There apparently is startlingly little confidence in the economy to grow long term, which might be Omicron related, because the real-time data, including, I would contend, the unemployment report, just don't give you any reason to think there's anything greatly wrong with the economy. It's growing.
So
you're looking quizzical.
No, here's my controversial idea of the day. I'll be honest. I have been having this feeling for a while, and I feel like stocks and bonds are moving in different universes. I think that people say that stocks have already sort of adapted to a rising rate regime, but have they really? I mean, honestly, today, the action in markets really highlights how little stock markets have sort of accepted what bond markets are increasingly pricing in, which is possibly 2 rate hikes, even more next year. And I see this because as traders got more conviction at the front end of the yield curve that possibly this report would do absolutely nothing to slow down the trajectory of a more hawkish Fed, you saw the NASDAQ, you saw the tech stocks tumble. And this is the knee-jerk response that you would expect. And it's the whole, good news is bad news kind of dynamic. But earlier in the day, before the open, we saw the opposite dynamic. It just shows how people are struggling to price a rate hiking regime. And this has to do with not only economic growth, but I think it also has to do with the fact that people don't know how much of the elevated valuations in equity markets really has to do with the Fed versus absolute profits and absolute growth. And this, I think, is one of the main mysteries in the market.
No, I agree with that completely. You would expect, it's quite mysterious how little of a tantrum you've had in real yields. That's one of the big conundrums at the moment. But the other conundrum is how we've managed to see the advent of so much inflation and so much of a change in perspective as to what we expect the Fed to do about it. And it's had minimal effect on stocks. I mean, over the course of the year, there's one reasonably straightforward explanation, which is PE ratios actually have come down pretty sharply because earnings have been really, again, rip-snortingly good. They're very much better than were expected, and therefore you get you can have the stock market rising while it derates, which is not an unhealthy thing to be happening. On a day-by-day basis, though, this is today is a risk-off day. It's the kind of from back in Lehman days or from briefly around the pandemic in March last year. This is risk off, buy bond, sell stocks day, because normally because you're thinking there is whatever you're most worried about out there in the environment has got worse that day, and I see neither from the Omicron news nor from the data in the economic data in their totality do I see any reason to think we need such a risk off day.
Well, you pick up on a really good point, which is there is a discrepancy right now in the run rate in the economy and the inflation projections and the absolute yields, the nominal yields, which are vastly lower. And this speaks to the sort of negative real yields that have persisted to a significant degree throughout the yield curve. Why can this be? Is there someone disagreeing with the economic outlook and predicting a slowdown? Or is this a bet on the Fed put? Right? The idea that they'll come in and they'll save any turmoil, any markets that are going down at all. And how much of the resilience that we're seeing in risk assets is a wager that the Fed cannot allow rates to rise too much because it will blow up the whole way that right now things are valued. How much of that is factoring into the valuations? And I don't know the answer to it. I wish I did, but I do think that there is this feeling that the Fed is going to work delicately, that they don't want to torpedo a market and an economy where they don't have that many tools left, or certainly not as much ammunition as they used to have to really counteract another downturn.
Now, I can go along with that pretty much 100%, Lisa. I mean, you also get from the chatter, as in the pure chatter one gets from feedback from readers, Twitter and all the rest of it, the amount of cynicism that we've got this Powell pivot and then there'll be another Powell pivot along in a few months once they realize they've scared the market. That is a very, very overriding belief. There still isn't a true belief that the Fed is having to go back to being a traditional central bank and taking punch bowls away when inflation appears to be going up. I think the other thing, if you want a sort of longer term factor that might be driving this, is that if you look at pension funds, either 401ks or DB pension funds, there is a great need to keep those. DB pension funds have had a fantastic year, but that begins to get prejudiced by if yields start to go down again. It really is important not to let the stock market go down too much. That freaks people out because so many people can see in real time what that's doing to their wealth, their net worth. So there is a belief that what we used to call the Greenspan put, and we've then called the put of whoever happens to be the chair of the Fed after that there is some sense that that's become a permanent item, that the Fed cannot let the stock market go too far. I'm not sure that that's right. Too much weight is being put on it. But I think you're right that there is this underlying sense that there is a Fed put. There is a limit to how far they can go, even if inflation really is taking off.
So the controversial question of the week, in my mind, is what made Jay Powell change his view so much from 2 weeks ago to 1 week ago to this week. And this sort of hints at, the cynicism that you're talking about. Which Powell are we going to get next year? Will he capitulate if the market throws its a little bit of a tantrum? Why did we get such a different calculus when it comes to weighing full employment, when it comes to weighing some of the different factors, widespread employment, with inflation, which suddenly seems to be taking center stage?
Again, continuing the cynical thing, if your job status your employment status is still in some question, you might be less comfortable making an aggressively hawkish pronouncement than if you've just been nominated for another 4 years in your post. So it's possible that there was an element of not wanting. If he had come out with such a hawkish pronouncement, and then Joe Biden had gone with Lyle Brainard, then we really could have had a very dramatic bunch of switchbacks on the bond market. We've had them anyway, but that would have been a very interesting situation if Powell had clearly nailed his hawkish colors to the mast, and then Biden had said, "Okay, I'm not going with the hawk." There would have been that would have been part of the calculation. Beyond that, I see it. And anybody reads my stuff with any regularity can see this. It strikes me that as time has gone by, it's become ever more obvious that there really is an inflation problem there, and that it is driven not just by supply but by demand. I.e., that you can say don't tighten into a supply shock, but you do tighten into a demand shock. You can. The Fed can definitely affect the amount of demand for stuff at the moment, and it probably should. So I suppose it's a combination of those two things. That Powell is now talking as the person who's been given the nod for the next 4 years, and the evidence has reached a certain tipping point in his mind that inflation isn't transitory.
I would completely concur, and I thought that was a really apt point about the potential whipsawing, especially with uncertainty around the Fed chair. We're out of time. There's so much to parse through. Next week shall be another very interesting week, the week ahead of the Federal Reserve meeting, as well as the Bank of England. How much will they actually make a move?
Yes.
We are expecting the Fed to announce the acceleration of their tapering. The jobs market, frankly, just muddies it more with, as you said, the Rorschach test of a slew of numbers. It does appear, though, that the labor market is improving. That does it